afternoon. This is a presentation by BrandGuard Software. And today we're going to be discussing reputation management, managing the global enterprise for banking and financial institutions. And before we dive in, let's distinguish and identify what is a brand. A brand is a name or a term, a symbol, or it can be a design. It's a combination intended to identify goods or services. And for this presentation, we're going to be talking through several of the attributes that convey meaning about brands, such as benefits, value, culture, personality, the individual users, and defining brand equity. And brands vary, especially in the financial services space, in the amount of power and value they have in the marketplace. At one end, you have brands that are unknown by most consumers. An example of this would be credit unions, geographically located. Then there are brands that have a high degree of brand awareness. Next are brands with a high degree of brand acceptability, and then brands with a high degree of brand preference and brand loyalty as a combination. And with brand equity, there are 5 levels of customer attitudes towards brands. And number 1 is that customers will change brands, especially for price reasons, so no brand loyalty. And you see this quite often when one financial institution offers a zero-interest checking account or a new product designed to attract a certain consumer segment. Customers that are satisfied and they have no reason to change the brand. And you see this a lot in lifetime customers. And next is how brand equity is related to these. So we're going to discuss all of these today, and let's dive right in. So, positive brand reputation. It's by far the most valuable brand asset, and it's neglected by financial institutions at a severe cost to shareholders and consumers. And just a little fact, one negative review costs 30 customers per branded term. And this becomes a huge expense when you multiply that by the lifetime value of one customer. So, banking reputations over the last few years have struggled through several of the financial crises, and this is an area where institutions can take an active role in managing and improving their online brand image. So let's discuss some of the shareholder losses on the banking and consumer side. In 2013, there are over 63,000 banking jobs lost in just 8 European banks. Foreclosures, this was the housing bust, over 12 million U.S. property foreclosures since 2009, and 3 million U.S. business bankruptcies in a 1-year span between 2009 and 2010. And banks have been the easy blame for all of these crises, and they shouldn't have been. Retail banks appear to have adequate financial resources today. These are from 2007. The IMF confirmed the continued resilience of the global financial system, and that's saying a lot. So, several areas were mismanaged. The top 3, risk management was caught unprepared, strategic interests were abandoned, and economic value evaporated on a massive, catastrophic level. How could reputation impact strategy? First, the continued success of a brand's reputation, especially in the online channel, needs to support and be accountable to stakeholders, by stakeholders, and this is at a negative sentiment towards banks. You can see from this cartoon, greed is good, but banking is better. And this was a popular cartoon. So, the worst decisions in these crises had a common theme. And these are just a couple of examples. Payment protection, insurance plans to improve your loan. It's like selling shaving cream as a cure for baldness. Arranging additional credit of up to $1 billion, and this didn't appear in the Greek economy's data. And the example is encouraging an alcoholic to have another drink, and creating and selling securities and then betting against them. And that would be, if you're a Dallas Cowboys fan, that would be like quarterbacking for the Dallas Cowboys but betting on the Patriots to win. And that's a huge no-no. Don't even get me started on that. So, reputation management consideration. As you can see from this scary smiley face, there wasn't a lot of consideration for online reputation management, and a lot of this has to do with the increase in technology, bandwidth, and the drop in consumer prices. So Warren Buffett was quoted, "If you lose money, I'll be understanding. If you lose reputation, I'll be ruthless." And this will be a core framework for this discussion today. So, the United Kingdom's leadership discussing the UK insurance space. Reputation is the industry's biggest weakness. Make sure that we create an environment where our reputation reflects our value to society and the economy. And just to step back from the cartoon earlier, the sentiment, and not only in the United Kingdom and on the global scale, but also in the North American economy, sentiment towards banks and financial institutions is the lowest it's been in the last 16 years. And in 2011, the Edelman Trust Barometer revealed that a negative online reputation not only inhibits a financial institution's ability to position itself in the marketplace, but the difference between stakeholders of trusted companies and stakeholders of distrusted companies. 51% of stakeholders of trusted companies believe positive information after hearing it once or twice. When you compare that to distrusted companies, and an example of this would be Bank of America's mortgage scam that's going on right now. And just 15% believe positive information after hearing it once or twice. And on the trusted companies, 25% believe negative information, whereas stakeholders of distrusted companies believe 57% of the negative information. This has a long-term impact, especially on the competitor side as well. Again, 16 academic reports support reputation management. And just a couple of quotes we're going to run through. We observed that the penalized firms' stock prices experienced statistically significant losses of approximately 9 times the fines and compensation paid. And this is just on the reputation of a financial services company. And we interpret the fall in equity market value in excess of mandated payments as the firm's reputational loss. This is from the Regulatory Sanctions, Reputational Damage in Finance Markets from 2011. So here's what a financial institution did for society. At one time, financed the Panama Canal, financed the first transatlantic cable, developed the first credit card, the first savings account with compound interest, financed the first jumbo jet and supertanker, also provided cash to pay salaries of NGOs. So what are the steps of change? Well, the first steps are to analyze the intersect between reputation management and strategy. And on the left you can see on the execution of a corporate strategy, you have anticipating threats and leveraging the opportunities. One fantastic example is from the food and beverage industry. We won't go through who specifically this is, but I think you can tell by the hamburger. And one of the key strategies is targeting customers young and keeping them for life, which increases the lifetime value of that customer. So in conclusion, focusing on online reputation management must become a core board-level function. Positive online reputation leads to exterior viewpoints, executing with strategic software, and improving shareholder value. Steve Hester, the CEO of Royal Bank of Scotland Group, is quoted as saying, "Banks need to reconnect with society. We can't do without banks. They are central to progress, enabling people, companies, communities to achieve their ambitions." Thank you very much, and if you're a financial institution, reach out to us and schedule a product demo today. We can go through where you're at and what we can do. Feel free to call us at 888-565-3690. That number is 24 hours a day. Or email us at sales@brandguardsoftware.com, or reach us directly on our website at www.brandguardsoftware.com. My name is David Ewing. Thank you.